You already know the value of convertible term and participating whole life insurance in your life, but how often do you get to speak to someone at the home office that issued your policy?
You are listening to Wealth Talks, and today we have two special guests for you from Ameritas Life Insurance Company, Mr. Rob Sharp and Mr. Kelly Halverson, both vice presidents of Ameritas. Welcome to the show, gentlemen.
Thank you. Thanks for having us.
It's great to have you here. Great to have you here. So, Mr. Rob Sharp, I know you have been you're vice president of Ameritas. You also own a winery in California. Side note, some people might like to know about you. And Mr. Kelly, I know you're an actuary as well as a vice president of Ameritas, and you both have some sort of say in the product development there at Ameritas. So we're looking forward to hear more.
That'd be great. Happy to do it.
So one of the things that we always hear when we're approaching a prospect for a sale of a life insurance product is why are you looking at a company that only has an A+ or a double rating instead of one of these fancy triple rated companies? And how would you respond to that? Because I know I've looked through the strength of Ameritas. That's why I'm so proud to represent them. But can you just give a little history of why those triple numbers or triple A's don't necessarily pan out to security for the client?
Sure, I'd be happy to do that. Number one, I think that you have to look at the difference between what would be considered a stock company and what would be considered a mutual company. And there's some definitive benefits from being a mutual-based company. Our owners are the policyholders, not necessarily investors or stockholders. That in and of itself, I think, is a game changer when it comes to looking at a carrier and the strength of it, and as well as the promises that they make. I think a second thing is more historical, just what we've seen in the past. Just over the last several decades, we've seen some pretty substantial failures of companies, or companies that have had some financial issues, maybe not necessarily full-out failures, but financial issues, very public examples of those, and they were AAA companies.
Yeah, one that comes to my mind right away is AIG in the 2008 crash.
Correct. And one can argue that what the reason was for that, but whether it was a parent or whether it was a subsidiary, but regardless, I think what you find is what you find is that it's not just the ratings in themselves don't really make the difference. I think it's the structure of the company, the holdings of the company, and also it matters as to what the growth pattern of the company is, and how they develop their product and the eye towards long-term profitability as opposed to just rapid, quick growth.
Well, one of the things that I like to share with our prospects is the capital and surplus to assets ratio that Ameritas has. It's really high, and I just think that this shows that the management at Ameritas is really paying attention to what's happening.
Right. Yeah. Ameritas has been around in one form or another way back to 1887. And it has grown through some acquisitions, Union Central and Acacia, that created the new version of Ameritas over the last number of years. But what you have, I think, is you have a very disciplined approach to, again, long-term growth, long-term vision as to what Ameritas is and what they can be. And when you look at the financials of Ameritas, I think it proves that out.
Well, go ahead, John.
So you mentioned that goes roots all the way back to 1887. Can you give us a little bit of a history of Ameritas' timeline?
Sure. Yeah. I mean, Ameritas started as Old Line Banker's Life in April of 1887.
That's a long track record.
Yeah, a long time ago. They were introduced in New York in the 80s and 90s. And then Banker's Life changed its name to Ameritas in 1988. as to reflect the growth that they wanted to incur. And then through acquisitions in 1998, Ameritas acquired Acacia, and then in 2006 it acquired Union Central. They called that Unify Companies, but eventually changed the name to Ameritas. And the idea, again, in general, is disciplined growth, whether it's through acquisition, whether it's through growth of policyholders, lives covered, that kind of thing, or it's just growth financially.
Mm-hmm. Another important thing to note as you look at the way that Ameritas is structured, I know you mentioned the strength of our balance sheet. We have one of the highest ratios of capital and surplus to assets of any company in the insurance space. We maintain really strong levels of capital and liquidity, so that we do have that strong financial strength. We don't have the ability to control how rating agencies view us, but when we do have our reviews by our rating agencies, we get very strong marks in terms of the amount of capital, the amount of risk-based capital we're holding relative to our obligations. So our balance sheet is extremely strong. The other point I wanted to make too about the mutual holding company structure, we're not in a position where we can go out and raise capital through the secondary markets or through stock offerings. The important structure we do have as a mutual holding company is the writing companies so basically Ameritas Life Insurance Corporation or Corp, as well as Ameritas Life of New York. Those companies are 100% stock held companies that are wholly owned by the mutual holding company. Mm-hmm. So a lot of times some of our peers or others in a mutual organization would say, well, Ameritas Life is a stock company. That's technically accurate. The writing company is a stock entity, but it is 100% held and owned by our mutual holding company. So really the policy owners of Ameritas Life wholly own Ameritas Life Insurance Corp through Ameritas Mutual Holding Company. So there's a little subtlety about the organization and the structure, but that's the way our mutual holding company is designed, so that really it is entirely owned by our policyholders.
That's a really good explanation of how that works, because we were just talking to someone yesterday who was concerned, this is a stock company. And no, you have to realize the way that it's structured is actually for even further policy owner protection, really.
Yeah. Yep. So one thing that you were mentioning, you're talking about the capital and surplus assets ratio, and I think this is a quote, from the 2018 or 2017 Ameritas annual report, says the statutory surplus levels of Ameritas Life and Ameritas Life of New York are above Standard & Poor's capital requirements at the AAA rating level. So that means you guys keep a lot of capital on hand. How does that help with the high guarantees that you can provide to policyholders? Because I know, especially looking at the Ameritas whole life insurance products, you guys have some of the highest guaranteed values in the whole industry.
Yeah, we pride ourselves on that. In my responsibilities, my day-to-day responsibilities are around the product development for our life and annuity business. So we not only pay close attention to how we build our products, but also to how they stack up in the broader market. And when we do our benchmarking, when we analyze the rest of the marketplace, we consistently have some of the strongest guaranteed cash values, both in true dollar terms for a given dollar face amount, as well as on an internal rate of return basis, where you're looking at the guaranteed premiums versus the guaranteed cash values those dollars generate. Mm-hmm. So between the Keystone Whole Life product and the Keystone Foundation Whole Life products, both currently marketed, we have really some of the strongest guaranteed cash values of any participating whole life products in the industry. It is a big part of our financial discipline and the way that we structure our company and our capital that allows us to support those really strong guaranteed cash values. You'll find maybe some higher published dividend interest rates or higher currently credited dividend rates, but those things will come and go as economic cycles ebb and flow, and the thing that won't change is the strength of our guaranteed cash value.
Certainly. And those dividend rates, different companies can publish different dividend rates. Maybe they haven't taken all the different factors out of it yet, though. The expenses, mortality, however that works. Different companies have different formulas for calculating and reporting those dividend rates, don't they?
Oh, absolutely. Yeah, most companies, it's certainly the way that we design our products, and I think most of our peers in the industry use a three-factor dividend formula. So there's components associated with interest that's based on the amount of cash value or reserve in the contract. There's a component around expenses that would have some negative expense element associated for a certain number of years. And then there's a component around mortality that would compare the expected mortality or the actual mortality that's realized over the life of the book of business to the valuation basis, which currently is 2001 CSO on those existing products I mentioned. So there's a number of different ways companies choose to position those products. Mm-hmm. Some may have a very high dividend interest rate that looks really strong, but have offsetting very high expense loads or elements in that dividend calculation that tends to limit the overall performance of the contract. Mm-hmm. On ours, we don't have that really high dividend interest rate. Currently, our dividend interest rate is 5%, mm-hmm. But we do have a pretty competitive level of mortality gain factor, as well as the expense element within our dividends that allow us to have some pretty strong dividend performance in both of the products I mentioned.
That's good. That's an important point.
So, Kelly, we deal a lot with the whole life product industry and people that take loans from those policies are often told in the industry that if the dividend rate is, say, 5% and the loan interest rate on a policy loan is like 4%, then you're actually earning a 1% in that spread. Can you explain why that's not an accurate statement?
Yeah, I can go into that. There's a few different technical details that fit into this equation as well. So the first sort of discussion that usually happens is what's direct recognition versus indirect recognition.
Yes.
So if we address that topic, direct recognition essentially means as people take loans from their whole life policies, that's going to have a direct impact on the dividend that's being credited in that given year. Indirect recognition would say, regardless of if you take loans or not, you're still going to be paid the same level of dividend had that not been taken. So mm-hmm. It is indirect, the effect of that loan in the result that in aggregate, the company is going to have a different overall budget or a different overall payout of dividend, different supportable levels. So it's an indirect recognition versus direct. With an Ameritas Life, we do direct recognition on our whole life products. And in the example that you just described, if there's a 5% dividend interest rate and a 4% loan interest rate, there is going to be an impact on the dividend that's ultimately payable. Right now, on Keystone Whole Life, for example, we have a variable loan rate, and it's currently credited at currently charged at a 5% dividend or a loan rate. We also have a 5% dividend interest rate on the product. So the technical aspects of it get a little bit hard to follow when everything's basically at a very similar level. But an interesting way to think about this too is everybody expects interest rates on a variable loan rate basis are going to move. Dividend interest rates are going to move over the life of the contract. Mm-hmm. So if those two things get out of sync, let's say if I'm illustrating a Keystone Whole Life product today with no loans and a 5% dividend interest rate, and then I do another illustration that shows with, let's say, a loan in the fifth year, and I assume that loan has a much higher loan interest rate. Let's say it's 8%, right? So mm-hmm. Moody's moves up quickly. The industry doesn't move up as quickly in their dividend crediting, so the dividend rate is still 5%, but Moody's is effectively resulting in a variable loan rate of 8%. With the way that our dividend structure works, the client would actually receive a higher dividend because they have a loan in place than if they didn't have a loan in place. And that's because of that direct recognition. We're going to tie the interest component to that loan to the loan interest rate that we're charging, that 8%. That's going to end up being, in the example I was looking at, in some instances it's 200% of the dividend on the basis when there was no loan taken. Then the opposite could also be true if in the scenario where you have just described, the fact that if you have a 4% loan interest rate and the dividend interest rate is 5%, you end up having a substantially lower dividend credited because that dividend interest component is going to be linked to the loan crediting or the loan charge rate.
That's
a lot. Threw a lot at you there, but did that help?
It's a great explanation. Yes. Great explanation.
So let's kind of jump courses here a little bit and let's talk about reinsurance, because many people aren't aware that there is reinsurance, although they may have heard of it. How does reinsurance play a role in Ameritas' strength?
Yeah, the reinsurance market has become a lot more concentrated in the last 10 or 20 years. But there are a number of very large reinsurers that we partner with across the various businesses that we write, life, annuity, disability income, also even in our group businesses. So we have several relationships with a lot of the major reinsurance companies on both our term insurance, convertible term products, our term insurance riders that are attached to our participating whole life products and our participating whole life products. We have open reinsurance treaties on all of those products. Mm-hmm. And it depends a little bit on the product as to what structure we utilize. But in most instances, we'll have a pool of reinsurers, usually 4 or 5 reinsurers supporting a given treaty. So let's say on the Keystone Whole Life product, one of the products we've been talking about a lot today, we have 4 different reinsurers that support our issuance of that business, and their participation is really solely on a mortality basis. So what we call yearly renewable term. So there's another structure that's co-insurance. We utilize that on some of our term businesses, but on that yearly renewable term, the reinsurer basically participates in the mortality risk of the contract. So let's say, for example, we issue a $10 million whole life policy to a client, and we typically, with that type of a design, we will keep the first $2 million of risk. That's our retention limit, up to $2 million per life. And then we would have, assuming we had an equal share of the pool, $2 million going out to each of 4 of the biggest reinsurance companies in the industry, mm-hmm. for a total of $10 million of coverage offered on that client. Now,
so you're spreading out the risk.
In addition to that, allowing us to have less concentration of risk of our capital or of our earnings to one specific life, it also helps to broaden that understanding and awareness of the expected mortality of our business based on reinsurer input and their understanding of the entire industry relative to our underwriting approaches. So it's kind of a win-win in the terms of we get less earnings volatility, less surprises, less capital commitments to one individual life, as well as a better understanding and information for informing our underwriting processes and understanding our experience as it emerges.
Wonderful. So this is really nice. So you're basically spreading out the risk. The reinsurance companies let you do that, but you still get to see everything that's happening with that whole book of business and apply it in underwriting and developing further products and making sure the company stays strong.
Yep, that's exactly right.
So one of the products that we really like with Ameritas, besides the Keystone, is the Keystone Foundation product, because we have found that that's one of the most competitive products when we're writing our business for a child. And what kind of went into the development of that product, and why is it a product that is so good for children?
Yeah, the Keystone Foundation product has been in market for nearly, I think it's right at 10 years now. Depending on the state that you're in, state approval dates aren't always exactly the same. But about a decade, we've been able to offer that in very much the same form it was originally launched. We've certainly moved the dividend interest rate since rolling that product out. But the specific question of why do the juvenile designs look so strong, I think it comes down a lot to the definition of how we design the guaranteed cash values in that product. So instead of just following the contractual, basically there's some regulations as to how much the non-forfeiture amounts need to be? What's the guaranteed minimum cash value you need to offer in these products? A lot of companies will design their cash values around those minimum requirements of some of these actuarial regulations. With our product, we took a different approach, and we used a significantly lower mortality assumption than what was required. So that led to a substantially higher early guaranteed cash value. That difference versus a lot of our competitors wears off after you get about 15 or 20 years into the contract. But those first 15 or 20 years of very, very high guaranteed cash value, that looks very compelling. And then the way that we position the premiums, especially on those juveniles, very low premiums, you get some really strong internal rates of return on those dollars. So basically the guaranteed premiums required versus the guaranteed cash values generated, those are some of the strongest you're going to find in the industry.
That product becomes a really strong adjunct to helping parents save for college education or for their child going into business when they're around 20, 21 years of age. We just love it. It's a great product.
Yes.
Excellent.
So something I would like to ask you is there anything we haven't asked you about Ameritas that you would like to talk about? You know, how the internal workings of the company, how you protect the policyholders, and how all that works.
You know what? I'll jump in. I'll jump in here real quick for I guess there's two parts to that. One is, and this kind of feeds into your observations and questions about the products too. Ameritas is a very field-facing company. A lot of our product development and the services and the concepts and so on that we provide flow through our field partners, the people who distribute Ameritas product. And we get feedback directly from them on a regular basis. And for example, Kelly partners with them to develop these products as well. So we know what clients are interested in because that's feeding directly through the producers who we contract with. I think that's very strong. And the field-facing nature of Ameritas is much stronger here than lots of other companies that I've been involved with in the past. And I think it shows. And then I think secondarily is it's easy to look good when you're with folks like Kelly Halverson, who is officially the smartest guy in the room in most cases. That helps. I think that really helps with our product development, looking from a long-term perspective as opposed to a short-term gain.
Great. Let's talk about one more thing that I'm really proud to represent Ameritas about, and that is your term products. They are some of the lowest cost to the consumer, but with some of the neatest guarantees, and that's the convertibility part of it to permanent life insurance. So how can Ameritas keep their premiums so low on those term products and still allow that convertibility to take place? And maybe you could touch on how convertibility takes place.
Yeah. This is Kelly. First, I have to address Rob's comment about the smartest guy in the room. I am currently standing by myself in my office, so I am officially the smartest guy. So your specific question on term conversion, this is a value we've offered for a very long time in our term portfolio, and one we take very seriously, being a mutual holding company. So we want members to continue to be members forever. Sometimes their budgets don't allow them to start off as permanent members of Ameritas, and so they'll start with a term policy. But we continue to emphasize the value of permanent life insurance, and we want to be able to offer that to clients as affordably as we possibly can. So the best way to get access to those clients before maybe their bank accounts or their budgets allow would be through term insurance, and we have between Keystone Term, the predecessor to our currently marketed Value Plus term product, those two products have consistently been very competitive. We benchmark across about 60 or 70 different companies, and we typically find our rankings to be in the top quartile, usually in the top 10 or 15, depending on your age or risk or gender, face amounts offered, those types of things. But the design philosophy of the premium positioning is consistent competitiveness. So we want the product to be competitive regardless of if your client's a 25-year-old preferred plus or a 45-year-old standard, if they're looking for 200,000, or if they're looking for 20 million, we want to be consistently competitive. So that's the premium positioning. By having some of the industry-leading conversion privileges, conversion that lasts all the way past usually working age, all the way to 70, or even on some of our older products to 75, that long-term convertibility all the way through the level term period, that basically prevents us from saying we're going to be one of the top 2 or 3 in the industry. So you're not going to find us at the absolute top of the spreadsheet in terms of competitiveness. We're very close. Maybe it's a couple dollars difference per month, but we feel like maintaining some of the industry-leading conversion privileges and having access to the entire permanent product portfolio is important enough to pay those extra couple dollars a month.
Exactly. Yeah, you can find really cheap term, and it often is just cheap term. no convertibility there. And so having such a great quality whole life product, permanent products to convert to, it really means a lot for clients.
I think that's also the value of this format that you're providing too, is education, because a lot of times, like you said, cheap term is cheap term. It's advertised. It's available on the internet. It's commoditized. Mm-hmm. But taking a long range view of what you want to achieve with these products, that's where Ameritas and this particular product shine, is the convertibility. When you look at a lot of competing carriers, there are limitations for convertibility and substantial limitations. I think that's what makes this stand out. So the format that you're providing here is good from an educational standpoint to say cheap term is not always the best way to go.
Yes.
So, Kelly, being we have the smartest person in the room amongst us, I want to ask you a question that's come up recently, and that's artificial intelligence underwriting. What are your thoughts about it, and where do you think it's heading in our industry?
Yeah, this is a topic I spend quite a bit of time thinking about. It has made some really big leaps and strides in the broader marketplace. So several of our competitors have implemented what they'll call triage underwriting or accelerated underwriting, automated underwriting, straight through processing, simplified issue. There's all these different names or terms that get thrown around fairly interchangeably, but the general theme and the fairly noticeable consensus is most companies are designing what I would call a triage underwriting approach, where it kind of comes down to a coin flip. So you're going to submit 2 clients to XYZ carrier, and one of them is possibly going to get through the process without having to do a paramed, without any fluids, and get to a very quick decision. Mm-hmm. The other one, after they get through that couple-day process of the initial review, says, we saw something that we want to look a little closer at. We're going to push this one back through a full medical underwriting process. So there's definite appeal to that approach and that design. It's one that we're actively researching and determining what kind of changes do we want to make to our underwriting processes to be able to facilitate some faster decisioning. And a lot of that comes down to the technology underneath what you're offering. Mm-hmm. But it's also led to some concerns from some producers and some clients too, where when you're used to what, very easy to understand, what the underwriting guidelines are, what the criteria is, and when some of the automated or accelerated processes use some predictive models or predictive analytics, different sources of data to come to decisioning, it's a little harder to communicate that to the client that there's something that you didn't expect was going to be used in the underwriting process ended up bumping you from preferred plus down to standard or preferred plus down to preferred. Mm-hmm. So I think the industry's got some more work to do to figure out how do we more effectively and transparently explain how some of these accelerated underwriting tools are being developed and then be able to disclose that more effectively to insureds. I know that it's an area of interest for a lot of our regulators. Several states have been asking vendors to really come in and explain what it is that their processes do. So we've been very close in understanding and monitoring what those do. We have our own jet issue program where we do up to $200,000 in face amount. We can avoid going through the paramed and the fluid processes in exchange for going through a tele-underwriting process. So it's been our initial foray into this. We've been offering that program for some time now, but it is an area where I'd expect to continue to see change. More vendors trying to get into the space and more carriers looking to broaden their offerings.
Is it a good analogy to say that it's similar to the driverless cars that are being tested in different cities around the world?
I think that's a fair analogy, and certainly on some of the programs, there's one of our competitors is utilizing tracking via Fitbits or Garmin's, some of your activity trackers where they'll track steps. So the nice thing is that your clients that are very active and very fit and want to continue to be so, they get rewarded for doing that. There's also the flip side to that, just like you said, on the driverless car, some drivers, they may get dinged because they don't have the best driving record or their habits aren't in line with what was originally expected. And it effectively becomes more of a post-issue rate adjustment or rate reclassification. Some would see it as post-issue underwriting. So there's a positive and a negative to any aspect of this. And some of those companies that have pursued it have decided we think the positive outweighs the negative, right? That the clients that really want to emphasize this, they would see more value in it than the ones that maybe don't see that as a big advantage for them.
That's interesting. Thank you for sharing your insight on that. And thank you, both of you gentlemen, for taking the time with us today. The minutes have just flown by on this podcast, and I think people are going to find it very helpful. Any final words that you have before we close the show for the week?
Kelly?
Well, I'll take a quick crack at that. I really appreciate both you guys, Tom and John, being willing to include us in your podcast. I think this is valuable work you're doing for the industry and for your clients to keep people educated on not just what's available in the marketplace, what matters and why term and participating whole life are important, but really try to get a better understanding and get a pulse of the broader marketplace and know what the carriers are thinking about this stuff too. So we certainly appreciate your willingness to have us involved and look forward to continuing the dialogue with you in the future.
Been an honor to have you, Kelly.
Thank you very much for the platform today too. It's great to have the ability to talk about a company that you're proud of. So we appreciate what you're doing.
Well, thank you, Rob, and thank you for your time too as well. I know you both are very busy, and this has been very educational, and it's. I know that everybody's going to benefit from having listened to this podcast over and over again.
That's right. This is definitely going to be a resource we refer back to quite often. You are listening to Wealth Talk, so we talk about solutions, money, and other things that create wealth in your life. Have a wonderful week.